Thank you. Thank you very much indeed, Mr. Krishnan, for giving us an invaluable peek into this fascinating world, blending financial strategy and legacy planning. And thank you for your thought leadership and sharing your observations. Well, ladies and gentlemen, on that note, let's also march ahead and let's now set the stage for our next discussion coming your way. We all understand that as equity markets surge, private credit is emerging as a compelling alternative. So beyond risk diversification, does it hold a stronger case in today's investment landscape? Or for that matter, with a shift towards lower interest rates, what does this really mean for GPs focused on credit strategies? Again, let's get to answer these questions by bringing on board our expert panel on stage. I'd like to please invite our set of panelists to please come on the dais. I'd like to please invite Shilpa Mankar Ahluwalia, partner, Shardul Amarchand Mangaldas & Co. I'd like to further please invite Anup Tulsian, Group CFO, Ashok Goel Family Office, Rashrat Kapoor, CIO, Modulus Alternatives Investment Managers Limited, Amit Kansal, Head Alternate Investments, Fixed Income, Aditya, Birla Sun Life AMC Limited. And to stitch the thoughts together, I'd like to please invite Ajay Ramanathan, Senior Correspondent, VC Circle. Thank you so much again to all of our speakers for joining in. And with that, let me quickly hand over the proceedings to Ajay. Over to you then.
Hello. Am I audible? So, private credit investments have really picked up in the last few years. I think if you look at 2024, the overall value of investments is around $9 billion odd. So, I mean, these days we have so many investments vehicles. Like, for example, you have debt mutual funds coming in. You have NBFCs that are trying to grow their corporate loan books. Anup, if I may come to you, so what is the role of private credit in such a scenario when you have so much choice? Where does private credit stand?
For a family office, as far as we focus is, it's largely on the performing credit side. There are various options and structures in the private credit, be it performing credit, be it stressed situation. There are options for debt funds with the equity upside. But largely, what we see is the opportunities on the performing credit side.
You want to come in?
Yeah, I just want to add. So, if you look at where private credit is fills a gap which is not catered to by the traditional banks and NBFCs. So basically, what we are catering to is the growth need. Basically, where any money goes in is going towards productive assets. So it could be our cost overrun finance, last mile financing, holding company finance. It could be a strategic capital where you are trying to address anything with the capital table like acquisition finance, bridge finance, buyout of private equity, or it could be an opportunistic capital where you are doing sponsor financing or anything which is opportunity in terms of cash flow mismatch. So I think it's supplementing or complementing the demand which is not kind of catered to or fulfilled by the banks and NBFCs or the debt mutual funds.
Rakshit, you look at largely big companies, right? So if you look at the interest rate cycle right now, I mean, it is safe to say that with the RBI cutting rates, that we are going towards a lower interest rate regime. So where do you look at private credit investments? What is the impact that you see of this on investments?
Thanks. I think it's a great question, especially there is a forward lower interest rate regime scenario. So I think historically what we have seen is that pricing of private credits has negligible correlation to benchmark interest rates, or I would say generally it's been very price inelastic. I think the reason is that look, these borrowers really come to the private credit world where either you have dislocated balance sheets, cash flow gaps, some regulatory arbitrages. So I think there is a specific need of capital at a point of time, and that's really not getting set by the traditional set, and consequently there is there's a risk premium, there is a higher spread that private credit funds do tend to really charge, and that's the sort of the risk premium that we have. So I think fundamentally correlating it to benchmark interest rates in economy entirely isn't really correct, and I think seldom it really gets followed. However, I think what happens is that I think once you sort of enter into a transaction, there may be a scenario where the credits get better over a period of time, the operating profile gets better, there are rating upgrades. So I think there is a refinancing, there is a redeployment at that point of time. So the underlying borrower may go to a cheaper alternative once his sort of specs look better. So I think to that extent, I think there is an impact. But generally speaking, I think you would not have a correlation to broader private credit pricing spectrum is what I would say.
So would we still maintain that it remain attractive in comparison to other fixed income investments?
No, absolutely. I think if you look at the fixed income space, I think let's divide it into two broad buckets. There is the upper end of the debt is what you call the liquid funds, the traditional liquid FMPs, etc. I think that are perfectly correlated with interest rates. And I think, the current benchmark and maybe 100, 200 basis points. I think, this is entirely a credit world, which depending on what strategy you run, could easily be between 12, 13 to 18 to 20%. So I think this is completely, the another set of sort of the risk and the pricing spectrum.
That's a good point there.
Yeah, just to add to what Rachit said, I think he has covered most of it. But if you look at the risk-free rate, which goes into the pricing, is comparatively a smaller percentage. Unlike when you are doing a GSEC kind of a lending, AAA or AA kind of a rated paper lending, where GSEC is the most part of the pricing, and then there's a risk premium. In private credit, depending on whatever strategy, like Rachit mentioned, if you are at 12% to 16, 17%. GSEC would be, let's say, 50% or less than that. So therefore, the inelasticity is relatively high. And in fact, that increases the attractiveness, because as your risk-free rate goes down and the premium over that, let's say, assumes is stable, even if it doesn't kind of increase, the percentage-wise, the alpha or the delta that you create makes it more attractive as compared to the traditional fixed income products.
Amit, if I may just carry on from there, even within the private credit space, you have so many varieties, right? You have specialty finance. I know a lot of people must be looking at, say, performing credit, but even outside of that, you have stressed assets, you have specialty finance, and so on. So, which particular subsegment do you think has garnered the most traction in recent years, or maybe even the last 1 year?
Yeah, thanks for asking that. I think it's a very pertinent question, and I think we hear that from a lot of investors. So first and foremost, I would like to say that it's a question of a risk appetite of the investor, right? One size does not fit all. So it's a question of risk reward. What is the kind of risk you are willing to take, and what is the kind of rewards you are chasing? If I have to take an analogy, from stock markets or equity, which a lot of people understand, it's like whether you want to go for the safety of a large cap or a nifty kind of a benchmark, or whether you want to go for a small cap thematic fund. So performing credit is more like your large cap or nifty kind of an investing, which is much more stable, safer. Whereas when it gets to special situation and stress asset investing, they are more like your small cap and thematic funds. So basically, it is a function of the kind of stability you want in portfolio, the kind of drawdowns or the volatility you are okay with. Like, right, again, I'm not talking because right now the market is correcting. When the market corrects, you would have much more kind of a higher drawdown or volatility in the small cap or the mid cap space. Similarly, in times of turbulence, there may be, kind of special situation and stress asset. You would need to have a little more patience and longer horizon. Whereas performing credit generally sticks to risk covers kind of a, transactions strategy. So it's much more safer. So I would say one size does not fit all. So one should make a choice depending on their risk return horizon.
On that point, Rakshit, you specifically at Modus look at medium-sized and larger companies. So from an investor point of view, what is the one thing that investors should keep in mind while looking at private credit? And maybe Amit can carry on from there.
Sure. So I think first of all, the large part of the private credit domestic side, you've really seen HNI and family office space that have really dominated the supply side of capital. I think 3-4 things very critical for all investors to sort of look at. I think first is really your well-articulated investment strategy as to what are you really doing, because as I think Amit also mentioned, credit is a wide world. Are you doing performing, you're doing special sales, you're distressed? What is the nature of credits that you're doing? And I think once you have sort of a rule box, I think it's important to sort of see that there is no drift, and there is generally you sort of paint within the box. So I think is very important. So basically, well articulated, well defined investment strategy. Second is, I think, general governance framework processes in terms of, do you have a process for everything? I mean, are there credit policy, there credit underwriting processes, and important is that really being followed. Third is really conflicts. I think to some platforms, of course, there are conflicts, so one has to sort of see that. And third, most important, that it's always there. I mean, what's your track record and performance based on the strategy that you've really anchored, and what's been the past achievements within that broader track record and performance.
Right. Anup, you want to add to that?
So I think Rakshit has covered it very well. Just would like to add from the family office perspective. So it's largely driven by investment policy statement as to where to put money and where to not. And largely what we seek is the preservation of capital and then some upside. So obviously on a traditional product like typical debt investment or a fixed deposits, the returns are not attractive. However, the capital is preserved. Hence, to get some upside while keeping the similar kind of risk in place.
I think first of all, the large part of the private credit domestic side, you've really seen HNI and family office space that have really dominated the supply side of capital. I think 3-4 things very critical for all investors to sort of look at. I think first is really your well-articulated investment strategy as to what are you really doing, because as I think Amit also mentioned, credit is a wide world. Are you doing performing, you're doing special sales, you're distressed? I mean, what is the nature of credits that you're doing? And I think once you have sort of a rule box, I think it's important to sort of see that there is no drift, and there is generally you sort of paint within the box. So I think is very important. So basically, well-articulated, well-defined investment strategy. Second is, I think, general governance framework processes in terms of, do you have a process for everything? I mean, are there credit policy, there credit underwriting processes, and important is that really being followed. Third is really conflicts. I think to some platforms, of course, there are conflicts, so one has to sort of see that. And third, most important, that it's always there. I mean, what's your track record and performance based on the strategy that you've really anchored, and what's been the past achievements within that broader track record and performance.
Right. Anup, you want to add to that?
So I think Rakshit has covered it very well. Just would like to add from the family office perspective. So it's largely driven by investment policy statement as to where to put money and where to not. And largely what we seek is the preservation of capital and then some upside. So obviously on a traditional product like typical debt investment or a fixed deposits, the returns are not attractive. However, the capital is preserved. Hence, to get some upside while keeping the similar kind of risk in place.
Yes, so maybe Ajay, just to add, I think what Shilpa said, I think, first is on the bottlenecks. I think my take has been that SEBI has, over the last maybe 2 odd years, I think there has been a flurry of circulars and to get this context and stage set in for private credit in terms of how the operating framework has to be there, whether from credits, whether to investment teams, whether to PPMs, etc. So I think a lot has come, a lot sort of seems to be keep coming in terms of guidance, circulars, etc. Second is what I feel is that, of course, as Shilpa said, that I think a lot can be done, but I think one area which I see an immediate thing that one should sort of do that is that, how banks and NBFCs actually have access to SARFAESI, and I don't see private credit AIFs which over a period of time is sort of getting a very large access of corporate assets book should sort of not have access to SARFAESI, which is just the one just among many things that sort of getting planned. So I think that's where I feel that SEBI is sort of working on.
Yeah, I just want to say, so if you look at right now in the Indian context, we have something called a CAT 1, CAT 2, CAT 3 kind of an AI, which kind of is quite prescriptive in nature if you want to, let's say, invest in listed debt you need to have maybe a CAT 3 structure, whereas if you want to go to unlisted CAT 2, I think maybe we could do with a little more flexibility, because now on one hand the regulator wants to deepen the corporate bond market, which means that we are going to see much more debt paper being listed. On another hand, you have this regulation where you kind of stifle the growth by prescribing. And another spin-off of that is the taxation. So CAT 2 is a pass-through in terms of income tax. CAT 3 goes for maximum marginal rate. So basically, if you look at the best case scenario for an investor is that I pay what I'm supposed to pay, which is the best case scenario. And the worst case is I might end up paying the maximum marginal rate. So I think probably if you look at some of the global best practices, the investment strategies need not be constrained or be prescriptive in terms of the vehicle. Vehicle is just an enabler, because again, if you look at AIF, minimum investment is 1 crore, whether it's CAT 1, CAT 2, CAT 3. There's no really additional protection being afforded to the investors by being prescriptive in nature. So especially when it comes to debt, maybe we could have a little more flexibility in terms of how much percentage of listed paper you hold, unlisted paper you hold. In fact, there is already a SEBI consultation paper that has come, where they are thinking of relaxing in terms of rated A or below. Second is again in terms of open-ended and close-ended. Now, if you look at a lot of investors, when we discuss, we go and meet a lot of these family offices, HNIs, they talk of liquidity. And if you look at some of the global best practices, globally you do get some kind of liquidity windows which are available. Wherein in India again we have a very prescriptive framework where we talk of that minimum lock-in in let's say CAT 2 has to be 3 years. So if we are enabled to obviously it depends on the fund manager how is going to do that, deliver that. But assuming that I can deliver that liquidity to the investor, I think I should have the flexibility to still maybe let's say go through a CAT 2 or a pass-through taxation rather than being forced to go under a CAT 3 structure where I have to at the fund level pay a maximum marginal rate of tax.
Arup, if I may come to you, so do you think that domestic, in the latter part of 2024, we saw that the lion's share of investments were being done by domestic funds. So do you think that is a trend that will continue going ahead as well?
I think this is more driven by the change in taxation rules actually. Right? And hence the demand for the credit fund has gone up in last couple of years. And I see that growing for some more time, in fact for a longer term, because the returns are being made by the funds where the banks and regulated institutions, say NBFCs, cannot do that kind of lending that a fund can do. So I think this credit fund will keep making money for the investors in and out.
I can just quickly add to that. I think that's absolutely right. Even we've seen a lot of change in deal structures. Earlier, the FPI route, which was the offshore fund route, we saw a lot of deals come in through that. But now with the withholding tax, changes, and also you layer on the hedging cost, that offshore capital route has definitely become much more expensive than what you see onshore.
Yeah, if I just may add, I think it's also got to do with that. I think domestic funds are much more closer to the Indian corporates. So in terms of the understanding of the Indian credit, as soon as you go below those big $1 billion kind of or $100 million kind of a deals, I think Indian fund houses have a much more deeper understanding and an advantage in terms of structuring, understanding the credit, and therefore being able to underwrite those deals. Whereas I think globally, I think their advantage is more in terms of scale, in terms of the kind of dollar amount of checks that they can underwrite. So I think that as you kind of try and create deals below those initial headline deals, I think domestic fund houses are going to have an advantage because we understand the corporate undervalue of India much more in greater detail, much more better than the offshore guys.
That's quite an interesting point. Now we can open the floor for questions. Please raise your hand, state your name and organization, please. No questions? I think we can top that off. Thank you so much. It was a great conversation.
Thank you. Thanks.
Thank you. Thank you to all of our speakers. I'd like to request you all to please come together. And Ajay, if I can also request you to join in for a group photograph with our panelists. Thank you so much again for joining us. And ladies and gentlemen, we will be going back to back with our next set of sessions as well. So let's also ensure we can keep it as engaging as possible from our members of the audience in the form of questions, or for that matter, in the form of your tweets coming as well, using the hashtag LP Summit 25. Without our next session, as we focus on real assets, we all know that when it comes to real assets, they present both the assurance of a physical estate and long-term value creation of an infrastructure property. So how do LPs look at real estate and infrastructure that come with their own nuances? Now, addressing this question and more, we have our next set of speakers joining us on the stage. We're about to get started with our next session right away. And this is all about the lure of real assets. That's the entire theme and the focus for our next session. Now, to spearhead the session, once again, we have with us Aman Malik, Senior Editor, VC Circle. So Aman will again be responsible in extracting all the relevant insights. But let me also go ahead and invite our speakers. We have with us Vishesh Narang, co-founder of VNAM, Head of Family Office at UKPI, promoter of Berger Paints India, and Sunil Dhal, CFA Investment Management with Al Raji Khan Group. Thank you so much again for our speakers for joining in. Time for another riveting session. So with that, Aman, I'm going to quickly hand it over to you again.
So let me actually start off, with the obvious question. And Mr. Dhar, let me sort of start off with you to begin with, if you will allow me. How important is real estate as an asset class when it comes to family offices outside of India, the geography that you operate in? And then for you, I'd like you to address how important has real estate become for family offices in India?
Good afternoon, ladies and gentlemen. Thanks, VCC Circle